Dividend aristocrats, the secret of consistent passive income. What if there were companies that have increased their dividend payments every single year for decades, even through recessions, financial crises, and market crashes? These elite companies are known as dividend aristocrats, and today we'll explore what they are, why investors love them, and whether they deserve a place in your portfolio. Part 1. What are dividend aristocrats? A dividend aristocrat is a company in the S&P 500 that has increased its dividend payout for at least 25 consecutive years. That means the company has consistently rewarded shareholders through both good times and bad. These businesses are often industry leaders with stable earnings, strong cash flow, and long-term competitive advantages. While high-growth companies focus on expanding rapidly, dividend aristocrats combine growth with reliable income. Part 2. Why investors like them. Dividend aristocrats offer several potential advantages. First, they provide a growing stream of passive income. As dividends increase over time, investors receive larger cash payments without buying additional shares. Second, these companies have historically shown resilience during market downturns because they tend to operate mature, profitable businesses. Third, reinvesting dividends can significantly boost long-term returns thanks to compound growth. For many long-term investors, dividend aristocrats represent stability in an otherwise volatile market. Part 3. Real examples of dividend growth. The real magic of dividend aristocrats isn't just that they pay dividends, it's that they increase them almost every single year, sometimes for more than half a century. Coca-Cola. Let's start with Coca-Cola. The company has increased its dividend for 64 consecutive years, making it one of the world's most famous dividend kings. That means shareholders have received a larger dividend every single year since the early 1960s, surviving oil crises, inflation, the dot-com bubble, the 2008 financial crisis, and the COVID-19 pandemic. Even in 2026, Coca-Cola announced another dividend increase of approximately 3.9%, extending its remarkable streak. Johnson & Johnson. Johnson & Johnson has an equally impressive history. The healthcare giant has raised its dividend for 64 consecutive years. Think about what that means. Investors who bought shares decades ago have seen their dividend income increase year after year, regardless of economic conditions. That's one reason J&J has long been considered one of the highest quality dividend stocks in the market. Procter & Gamble. Procter & Gamble may be even more impressive. The company has increased its dividend for 70 consecutive years, one of the longest records among large U.S. corporations. P&G has paid dividends continuously since 1890, and management has increased that payment every year since the mid-1950s. Its most recent increase in 2026 raised the quarterly dividend from approximately $1.06 to $1.09 per share, extending the streak to an incredible 70 years. PepsiCo. PepsiCo is another excellent example. The company has raised its dividend for more than 50 consecutive years, despite operating in a highly competitive food and beverage industry. For long-term investors, PepsiCo demonstrates how strong brands and stable cash flows can translate into decades of growing shareholder income. Sherwin-Williams. Sherwin-Williams isn't as famous as Coca-Cola or Pepsi, but its dividend history is equally impressive. The paint and coatings manufacturer has increased its dividend every year since 1979, representing nearly 5 decades of uninterrupted dividend growth. Even in 2026, management announced another increase, proving its continued commitment to returning cash to shareholders. Part 4. Are they risk-free? Not at all. Dividend aristocrats
Hugging
can
this
still
dividend
experience
aristocrat feels so
significant stock
safe and
price
rewarding.
declines during
Wow,
bear markets.
look at those tech rockets soar.
Some may also
But
grow
my
more
tree grows
slowly than
steady.
technology
Time to check
companies
the
or emerging
fundamentals.
industries. A long dividend history doesn't guarantee future performance, so investors should still evaluate earnings, debt levels, and business fundamentals. Conclusion. Dividend aristocrats demonstrate that consistency can be just as powerful as rapid growth. By increasing dividends year after year, these companies have built a reputation for stability and shareholder-friendly management. If you're investing for the long term, Dividend Aristocrats may be worth researching, but remember that every investment carries risk, and past performance does not guarantee future results. Bonus section: The power of compounding. Imagine investing $10,000 into a company that pays a 3% dividend and increases that dividend by around 6% every year. Your first year's income would be about $300. 10 years later, without adding a single extra dollar, your annual dividend income could exceed $500. After 20 years, your yearly dividend income could approach $900 or more, especially if you reinvest every dividend payment into additional shares. This is why many dividend investors don't focus on today's dividend yield. They focus on dividend growth, because growing income compounds over decades. Closing idea: the biggest lesson from Dividend Aristocrats isn't that they make investors rich overnight. It's that they reward patience. Companies like Coca-Cola, Johnson & Johnson, Procter Gamble, PepsiCo, and Sherwin-Williams have demonstrated that consistently increasing dividends over decades can create a steadily growing stream of passive income. For long-term investors, that's often more valuable than chasing the next hot stock. Time in the market, combined with growing dividends and reinvestment, can be one of the most powerful wealth-building strategies available. Part 6: What if you don't want to pick individual stocks? Buying individual Dividend Aristocrats is one option, but what if you don't want to analyze dozens of companies or build your own diversified portfolio? Fortunately, there's an easier solution: Dividend Aristocrats ETFs. An ETF, or exchange-traded fund, allows you to buy dozens of dividend-growing companies with a single investment. Instead of researching every company yourself, the ETF automatically tracks an index of Dividend Aristocrats and regularly updates its holdings. Option 1: United States Dividend Aristocrats ETF. SPDR S&P US. Dividend Aristocrats use its ETF ticker, US/SPY, depending on exchange. One of the most popular choices for European investors is the SPDR S&P US. Dividend Aristocrats use its ETF. This ETF follows the S&P High Yield Dividend Aristocrats Index, which contains American companies that have consistently increased or maintained strong dividend policies over many years. The portfolio contains roughly 150 to 160 companies across many sectors, including healthcare, consumer staples, industrials, utilities, and energy. Instead of owning just Coca-Cola or Procter & Gamble, investors instantly gain exposure to dozens of quality dividend-paying businesses with a single purchase. The annual management fee is approximately 0.35%, making it a relatively inexpensive way to access a diversified dividend portfolio. Bonus: Global Dividend Aristocrats. Some investors go even further and choose a global dividend ETF. For example, the SPDR S&P Global Dividend Aristocrats UCITS ETF invests in companies from North America, Europe, and Asia Pacific, offering worldwide diversification while still focusing on companies with attractive dividend histories. Whether you choose individual Dividend Aristocrats like Coca-Cola or Procter & Gamble, or simply invest through a Dividend Aristocrats ETF, the underlying philosophy remains the same. You're investing in companies with long histories of profitability, resilience, and rewarding shareholders year after year. For many long-term investors, this combination of growing income and potential capital appreciation makes Dividend Aristocrats one of the most attractive strategies for building wealth over decades.